FRG presents an informative video on fundamental analysis. So, moving further on, what is fundamental analysis? Fundamental analysis is a method of determining a stock's real or fair market value. Fundamental analysts search for stocks currently trading at prices higher or lower than their real value. If the fair market value is higher than the market price, the stock is deemed undervalued and a buy recommendation is given. If the fair market value is lower than the market price, the stock is deemed overvalued and the recommendation might be not to buy or to sell if stock is held. In contrast, technical analysts favor studying the historical price trends of the stock to predict the short-term future trends. Fundamental analysis is really logical and systematic approach to estimating future dividends and share prices. It is based on the basic premise that share price is determined by a number of fundamental factors relating to the economy, industry and company. It is a detailed analysis of the fundamental factors affecting the performance of companies.
Now, let's talk about importance of fundamental analysis. First, it is one of the most reliable methods for making long-term predictions. Second, analysts often use this, along with technical analysis, to form better financial and investment decisions. Third, fundamental analysis can prevent investors from making hasty decisions that may not turn out to be lucrative in the long run. Fourth, used to identify businesses and companies which have the potential of giving excellent results. Now let's talk about the difference between technical analysis and fundamental analysis. Differences are made on basis of purpose, value of share, decision making, and long-term, short-term price movement. Purpose. In fundamental analysis, it seeks to forecast stock prices on the basis of economic, industry and company statistics. However, the most important variables considered in deciding stock prices are earnings and dividends, whereas, in technical analysis, it mainly focuses on internal market data. Long-term and short-term price movement. The technical analysis determines the short-term price movements of the securities. The technician is a trader who buys and sells securities for short-term profits. Whereas in fundamental analysis, it seeks to predict long-term values of securities. The fundamentalist is a conservative who invests his funds for a long term. Long-term investors buy a high dividend-paying stock and hold it for many years through market fluctuations. Values of share. The technician believes that there is no real value to any stock. According to him, stock prices depend on demand and supply forces which in turn are governed by rational and irrational factors. Whereas in fundamental analysis, it estimates the intrinsic value of shares and purchases them when their market price is less than the intrinsic value. Decision making. In technical analysis, it listens to what the market has to say. So, the view of the market is the most important factor in determining stock prices. Whereas in fundamental analysis, the fundamental analysis carefully studies the financial statements, demand forecasts, quality of management, earnings and growth. Then they judge the prices of securities. Now moving further to types of fundamental analysis. First type is qualitative fundamental analysis, and second type is quantitative fundamental analysis. Let's talk about qualitative fundamental analysis. First, management. Some believe management is the most important criterion for investing in a company. It makes sense. Even the best business model is doomed if the company's leaders fail to execute the plan properly. Second, the business model. A business model is a company's core framework for operating profitably and providing value for customers. Features of an effective business model explain the customer value and pricing strategy. Third, competitive advantage. Competitive advantage is what makes an entity's products or services more desirable to customers than that of any other rival. A company's long-term success is primarily driven by its ability to maintain a competitive advantage and keep it. Fourth, corporate governance. It describes the policies in place within an organization, denoting the relationships and responsibilities between management, directors, and stakeholders. Fifth, industry. It's also important to consider a company's industry, its customer base, market share among firms, industry-wide growth, competition, regulation, and business cycles. Learning how the industry works will give an investor a deeper understanding of a company's financial health. Moving towards quantitative fundamental analysis. First, the income statement. The income statement measures a company's performance over a specific time frame. Technically, you could have a balance sheet for a month or even a DES, but you'll only see public companies report quarterly and annually. The income statement presents revenues, expenses, and profit generated from the business operations for that period. Second, statement of cash flows. It represents a record of a business cash inflows and outflows over a period of time. The cash flow statement is important because it's challenging for a business to manipulate its cash situation. Third, the balance sheet. The balance sheet represents a record of a company's assets, liabilities, and equity at a particular point in time. It is called a balance sheet because the three sections, assets, liabilities, and shareholders' equity. Fourth, financial ratios. It compares line item data from a company's financial statements to reveal insights regarding profitability, liquidity, operational efficiency, and solvency. Examples of ratio analysis include current ratio, gross profit margin ratio, inventory turnover ratio. Now, let's talk about components of fundamental analysis. First, industry analysis. Second, company analysis. Third, economic analysis. First we will talk about economic analysis. Economy analysis include GDP growth, inflation, political stability, trade deficit, war economy, etc. Industry analysis. Industry analysis includes growing industries, future opportunities, young or mature, economic factor, etc. Company analysis. Company analysis includes economy, industry and past performance. EIC analysis could be done in two ways: quantitative and qualitative. There are two approaches in EIC analysis: bottom to top and top to bottom approach. How to start fundamental analysis? There are 5 to 6 steps that you need to follow to analyze the fundamentals of a company. For example, a stock is trading in the market for $10 per share, and an analyst has published results and determined it should be worth $16 after considering all fundamental factors. However, another analyst suggests it should be worth $14, also significantly above the market price. So here are the steps for fundamental analysis. Step 1. Understand the company. Step 2. Use the financial ratios for initial screening. Step 3. Closely study the financial reports of the company. Step 4. Find the company's competitors and rivals and study them. Step 5. Check the company's debt and compare with rivals. Step 6. Analyze the company's future prospects. That's all about fundamental analysis. Hope you understood it. Thank you.